What's up, traders? I've got a quick one for you tonight. It's all quiet out there on the S&P 500 front as we round out the remainder of the shortened holiday week and really the remainder of the 2022 trading year. If we look down below at volume, it's significantly tapering off. I would just argue that this is consistent with Wall Street still being on their holiday vacations, as am I. And in our absence, we have certainly seen the bulls and bears achieve a little bit of a ceasefire agreement into the remainder of the trading year, really primarily coming from the analysis of the Thursday and Friday interaction from last week, which we'll get to momentarily. But from a timing perspective, let's take a page out of the history books and remember back to 1914, World War I. Both sides come out of the trenches and spend the holidays together only to, quote unquote, resume business, to put it very lightly, in the beginning of the new year. So for the market and a timing perspective, will that mean that we see the continued neutrality here, the ceasefire continue, neutral action for the next 3 days, and then the bull and bear battle resume when Wall Street returns to the desks to kick off 2023? Seems likely based on the evidence that I'm seeing out there in the market. This story all gets kicked off on the weekly time frame chart. What's going on here from a structural and location-based perspective? For structure, we've certainly got a change in tone as of the close of last week. We've produced a little bit more of a hammer candle here, where that lower wick would certainly represent buyers stepping up and pushing prices up towards the opening print. But let's not get overly ambitious. It's still a red-bodied hammer, so the buyer's unable to recapture the opening print, unable to expand range in the upward direction. It was bullish, just not as bullish as it could have possibly been. In terms of location on the bar-to-bar count, we did produce a significant and sizable lower high. The reason it's significant is because the buyers, again, not showing any true strength and unable to backtest the breakdown point, which was the bottom end of the weekly balance. I've also got an issue with the low. We produced a new lower low, but where did we close? Right back inside of the prior week's range. Why was it that the sellers were unable to materialize and close underneath the prior week's range on the really intense selling momentum from Thursday morning's session of last week? If the sellers were going to be more aggressive, it should have closed underneath. It simply wasn't the case. They're running out of bullets down here towards the lows. Maybe no one wants to hold short over the shortened holiday week into the remainder of the trading year. I don't know what the story is exactly, but the sellers not really all that impressive at the lows. So with that being said, if the buyers are not impressive, if the sellers are not impressive, is it a perfect storm for a sideways week as Wall Street is on vacation? To me, the answer could certainly be yes. Now, this is a micro-analysis of the small interaction right here, but on the weekly time frame chart, let's not get it twisted. The overall story of 2022 has certainly been the resistance trendline and the weekly 50 SMA providing lower highs over and over and over again, and this time is no different. As soon as we broke down underneath these lows and we confirmed a daily downtrend in here, the target should be on the weekly perspective, the equal low test, much closer to 355. So just pointing out that overall, the downtrend is still very much alive, and the target should be for lower in the grand scheme of things. Now, when and if we get here, we'll see if we produce a lower low to preserve the weekly downtrend or bounce to start to threaten the weekly downtrend. Does this make sense as well from a volume-based perspective? Let's see. I would argue yes, things are definitely more bearish than bullish the more time we spend underneath this high volume node, which we have failed to hold as support, roughly around SPY 390. So with last week being spent entirely underneath, the more time we spend underneath, the more likely it is that we rotate through the low volume void, and the next volume support that's significant is the great reset to the pre-sickness highs closer to 340. Again, not making the argument that we do this in the shortened holiday week into the remainder of 2022, just pointing out that over the long haul, the downtrend and the bearishness is still very much alive in this market currently. Now, contrarians are probably screaming at the screen saying, hey, what about that possibility of a weekly higher low? You're absolutely right. There could be a weekly higher low that's developed here, but I would not really subscribe to that narrative until a couple of things happen. Step number one is recapturing the bottom of the weekly balance range from right here, and step number two would be getting into that resistance trendline. If we do something like this and then get into the resistance trendline, maybe the story of 2023 is breaking out over the weekly resistance trendline, but one step at a time. If I just clear up these drawings, notice that to achieve step number one, there's still quite a ways to go in the upward direction. And with low volume, with Wall Street out of the office, I'm not necessarily convinced that we should be overly bullish just yet. So let's keep that as a back pocket situation. Seems like a lower probability outcome as of right now. Here's the daily time frame chart. What can we see from a weekly expected move perspective? What else is going on over here? So here's the expected move. Upper edge is roughly SPY 390. Lower edge is roughly SPY 375.30. If we're contained, it's still a big time lower high from here to here. And if we get the equal low, it just sort of preserves bear flag consolidation, I would say, something that would look like this. Now, a measured move based on that pattern, if we scrunch up the chart, easily takes us to those lows closer to 355 that we were just discussing on the weekly time frame chart, right? You take this distance resistance, and you stack it right here, and there you go. It brings us right to the level. Now, what if we get a breakout of these 3 equal highs, which we'll talk about momentarily? We go all the way here and then roll over. Well, let's entertain the possibility of a head and shoulders pattern. It's still bearish, right? We're underneath that weekly overhead level at 394.50. If this takes place, then my goodness, that's even more bearish, because we know that the measured move is from the head to the neckline. Then you stack it here where we break down, and that easily, based on a quick eyeball, I would say that's conservative, right? That's through the 355 area. So bearish no matter how you look at it, as long as we're underneath 394.50, which currently we certainly are. Now you might be saying, well, Matt, if you're so bearish, put your money where your mouth is and just, short this thing into the ground and, collect your money if you're so confident. Well, that's the thing. I'm not so confident based on what took place specifically from the Thursday session of last week. We undercut the Monday and Tuesday low on big time selling momentum, which we'll see in the internals momentarily, and then we stop on the dime and get a big time reversal, and as we saw on the weekly, close back inside of the prior weekly range. Why were the sellers sort of deterred from this level here if the weekly support should have been coming in much lower, around 371.25? I mean, look at this. Look at the stopping power of what took place last Thursday, right? Big selling momentum, little pause, big selling momentum, and then on a dime we turn around and close back closer to the upper third of the Thursday range, right? It's not like we have an hourly double bottom. It's not like we have an hourly inverted head and shoulders. It's just immediately bullish engulfing bar, follow through, close at the highs. What's up with that? To me, that's kind of odd. It's not indicative of new money buying. And because of the amount of volume that we've seen here, I wouldn't really be convinced that it's short covering either. Plunge protection team, I don't want to get too tinfoil hattish, but something about that buy up on last Thursday does not really sit well with me. And knowing that there's possibly something happening here, I would not want to short into that until we get another confirmed lower high that does this, or continue to go sideways and possibly break, retest, and then move lower underneath that low. So confirm it as resistance, right? So that's how I'm looking to play these charts. And again, based on the follow through from last Friday and the 3 equal highs that we have here now, we'll see a poor high on the market profile momentarily. If these 3 equal highs go, we could easily get a rotation into 390, and that's where I would look to position for shorts if we get a nice clean inverted hammer, if we see an intraday double top, intraday head and shoulders up there, and that would play into the bearish narrative that we've been sort of pushing forward so far in today's video. So in the short term, neutral in the remainder of 2022, watching to position for shorts here, or possibly on a breakdown lower high underneath 375.50, give or take. Now, the reason I don't necessarily think we're going all the way to 394.50 for that lower high is because we're seeing big confluence of resistance in this general area. We've got the daily 50 SMA. That's the blue moving average on your screen. We know that it's the weekly high volume node. It's the weekly resistance area. And then if we throw on the anchored VWAPs as well, and have a look here, the 2022 low, the last trendline touch VWAP, the CPI VWAP here, it's all confluence of resistance in this general area. And even further, the icing on the cake is if we take out the Fibonacci's and come from the high to the low of last Thursday, you'll notice that the 38.2 is stacked in there for confluence of resistance as well, preserving the idea that bear flag consolidation is content and happy, looking for bearish outcomes as long as you remain underneath 390. So far, I think it's pretty compelling that we stay here, as we'll see in the internals momentarily, as well as the sector posture. It's still defensive out there. I'm not seeing any big risk on shifts as of right now. But before we go to the internals, I just want to share one last fib perspective from low to high of this move here. And in terms of sticking with trench warfare analogies, in between the 38.2 and the 61.8, we have what we call no man's land. And that's exactly where we're trading. That, again, bodes much better for neutrality instead of bullish or bearish outcomes. Buyers content over the 38.2, sellers content underneath the 61.8. We don't have either of those things. We are in no man's land. Let's have a look at the market internals and see what we can learn from this perspective. Top right-hand corner's got you covered with a brief tutorial if you don't know what this screen is. You might be saying, Matt, look at the net inflows in the cumulative read on volume. It's bullish. It's got to be going higher. And the market was getting inflows. Well, not so fast. I know the indicator is not released yet, so no one would technically know, but I mean, look at the, this is significant. This is insignificant. This is really balanced. The significant reads are approaching 1 billion or just plus or minus 700 million, right? Something that looks like this is much more indicative of inflows. If this were sustained and stayed up here, that's also much more indicative of inflows. So far, I would say that last week from a volume perspective is much more balanced. What we can do is read into the Thursday session. Remember that this is the big break breakdown from Thursday. Here's the rally. Notice that the volume did not pick back up. So again, not really indicative whatsoever of new money buyers. There was strong selling momentum early on in the Thursday session. And again, to see that not really materialize lower, that's why we're cautious as we move forward into this shortened holiday week. In terms of the advanced decline line, a little bit of an oversold correction underneath negative 2,000. Again, not indicative of new money buying. And then the tick is fairly neutral with reads on both sides of the zero line throughout the course of last week. Thursday, sure, it was bearish, but getting a little bit more mild into the close, not as bearish as it could have possibly been. Again, sellers not capitalizing on that big momentum raises some questions, and we would want to be cautious about new money shorts until we get a little bit more confirmation on the lower high or the breakdown and then lower high underneath 375.50 that we were just discussing. Here's the market profile. What I want to point out from this perspective is the three equal highs. It's a poor high here. And if we breach and go to the 390 that we've been discussing in the SPY itself, from a futures correlation perspective, it's roughly 39.50. Okay, so looking for the lower high here, then rejections, that keeps us bearish in the grand scheme of things. Some things that help build the case for neutrality, and another reason why you don't want to be aggressively short here, is look at the value area from Thursday. It's smack in the middle of the Thursday range, as is the point of control. I mean, the purple line is half back, right? So point of control is right there. If it was going to be stronger selling, point of control should have shifted lower with price. It was absolutely not the case. On Friday, value is actually overlapping to up, and the point of control is discernibly higher with price. So again, if you're going to be bearish here, a little bit of caution based on what we're seeing in the market profile as well. There's your poor high. From the Tuesday session today. If it breaks, again, looking for that little bit of a small rally to unfold just to repair those highs. It doesn't mean anything overly bullish, just looking for that to be repaired possibly as a structural deficiency. So that's the market profile tutorial for you in the top right-hand corner if you don't know what it is. Let's round out the remainder of today's analysis by very briefly going through our sectors and just talking about risk on versus risk off. Energy sector breaking out of this balance area here in the upward direction. This is D for defensive, much more risk off. If the market sees a breakout and it's led by energy, I wouldn't trust it as far as I could throw it. Same thing with utilities. I mean, look at the move here, not undercutting the lows of Monday and Tuesday, instead rallying and getting above that hammer candle from Thursday. To me, this is much more defensive. This is much more risk off. If it leads to a rally in the S&P, again, wouldn't trust it as far as I can throw it. Same thing here with the XLP. I'm not going to beat that metaphor into the ground, but you'll notice we didn't even come close to taking out the Monday and Tuesday lows on Thursday, and now we're higher as well. This is D for defensive. It is not a risk-on type look. XLI is becoming a little bit more meaningful for our market, but still underneath the overhead supply at 99. Looking to resolve this either higher, keeps the market neutral, and maybe we try to find that lower high off 390. Staying down here, much more bearish, obviously underneath 99. Definitely not risk-on by any stretch of the imagination. Same thing with the XLY, not risk-on by any stretch of the imagination. Continued and sustained breakdown with what's been going on with Tesla, even if this rallies, strong opportunity for a lower high underneath 135, noting that this is a much more risk-on sector. Doesn't look good for your S&P 500. Same thing with the XLK, getting continued price action in the downward direction. Here's the overhead balance. We know that we had the fake break in the upward direction. We already found the lower high here, and we're threatening a breakdown of a flush point, 3 equal lows. Now, if we take this out and recapture 124.25, maybe we do something like this, but guys, remember, it's still just bear flag consolidation. It's still bearish in the grand scheme of things, anywhere really, underneath 129.50, so not convinced that this is bullish yet for our market, and the more time that we spend in the original balance here, the more bearish it becomes, the more we're likely to threaten that 119.75 and possibly break it down. Remembering that this is the heaviest weighted sector for the market, does not look great for bullish outcomes. That's why we spent some time on it here. But moving quickly through the remainder, XLC is a risk on sector, looks bearish. Here's an overhead balance. We're spending time underneath it. The longer we spend underneath 48, the more bearish it becomes. Even if we crack this and we do get a little bit of lift, strong possibilities for lower highs at any of the overhead levels, primarily 49.20. Next up is the XLV. This is healthcare, second heaviest weighted sector for the market, sideways just above that area of stubbornness we had discussed in prior videos. So this is actually a neutral data point. If it's going to break out here, it's possibly bullish into the remainder of the week, but still you've got to contend with that 137.15. Remember, it's also D for defensive in terms of posturing. Although it's the second heaviest weighted sector, we want it to participate in market rallies. It's not great from a risk on, risk off type look to see, healthcare outperforming. Next up, XLF. Financials. This is where there's the possibility for something more risk on to take place. XLF is one of the only risk on sectors that looks good. And the reason being, again, is that we did not take out the Monday, Tuesday low. We're above the hammer candle. You could make the argument that this is much more of a double bottom type look. We've got to recapture and break out over this, recapture that 3450. But if that can happen and we get a higher low, maybe it's back off to the races. We're not out of the woods from a downtrend perspective. We've got high, lower high, possibility for a lower high, even if we take out 3450. I'm just pointing out that with these equal lows now, there's the possibility of a trend reversal if we start to see higher low above 3450. So financials are a place to keep an eyeball out, just based on the analysis of this and what we'll see in the ratio grid momentarily. Materials, sorry. Lightweight sector, not going to read into it too much. Same idea, possibility of a breakout, but still lower high underneath 80.75 keeps us a little bit more neutral on the market. It's not really all of a risk on look. Same thing with real estate. This has much more to do with the wealth effect. We're not aggressively over 39. We're not threatening that move anymore. So not really a bullish force for the market, kind of neutral in here, concerned about lower lows only underneath 34 as bearish pressure. Let's have a look at the ratio grid and quickly see what's going on from a risk on, risk off perspective. Top right-hand corner's got you covered with a brief tutorial. Top four are the risk on sectors. Notice what we just discussed in the XLK. Big breakdown on a relative strength perspective in the downward direction, so not bullish by any stretch of the imagination. Very hard to have a risk on look for the market with this pointing aggressively lower. XLV is defensive in nature, but again, second heaviest weighted sector, it needs to participate. So it's pointing higher, it looks okay, but as we know, it's not really risk on. XLF, this is where, again, we're starting to see a little bit of development in the upward direction. This is a positive indication. But in the face of an XLY that's absolutely falling off of a cliff, in the face of an XLK that's falling out of a box, not great, right? In terms of the risk off sectors, bottom four down below, every single one of them is pointing in the upward direction. XLP consumer staples, energy, utilities, and even real estate perking up just a little bit. Very hard to have a risk on look when everything here in the bottom four are looking bullish, right? That's a risk off look if I've ever seen one. So not out of the woods from that perspective. Let's have a quick look at our XLY over the XLP. Just remember, growth versus value. Value continues to outperform. Growth underperforming. Growth is what we need for a risk-on type market. Out of the picture. Big lower lows, well underneath the resistance trend line. Bearish for the market. Next up is the dollar. What's going on with the Dixie? Certainly looking a little sneaky here. Watching for the possibility of a wedge type pattern. A falling wedge is actually bullish. Looking for that to move higher. And with a couple of failed breakouts now in the GC, let's have a look at gold. Maybe that's going to be a reality, but gold has really got to stay in the range and possibly break down underneath the upper wick from today's session, the failed breakout from late last week, and the failed breakout from here. It doesn't look like it wants to go in the upward direction, so I'd be watching gold underneath 1780 for a bullish move in the dollar, which is then bearish for our SPY. So overall, bearish relationship in our dollar from the perspective that we've just taken a look at. Let's have a look at the TNX signal study because this is firing in the upward direction. This is primarily why I wanted to make tonight's video, because I told you I would update you when it happened, and it's happened, right? So rates aggressively starting to move in the upward direction is typically bearish for our market. We can see the last signal study here and here signaling bearish outcomes, so this would not bode well for any sort of bullish narratives that we're looking for into 2023. Remember that this has the most impact on the XLK, which is the heaviest weighted sector, the most aggressive risk on sector. It's really, really tough to have, sustained outperformance there when rates are moving aggressively higher, as we're seeing in this picture. Next up, we'll take a look at the TLT. With rates aggressively moving higher, we're continuing to see a depression, obviously, in the TLT. So let's actually go to the 3-month. There we go. So that, flight to safety classic type trade, it doesn't look like it's panning out any longer, but I think that's maybe not artificial. It's probably not the right word, but it's being impacted, obviously, by rates continuing to move in the upward direction. So still a tough look in bonds. It doesn't really seem like a safe haven, and that flight to safety trade may continue not to work out. We know it didn't work out for all of 2022. So the tides started to look like they were shifting, but as of right now, back to that, it's tough everywhere in the market. There's no hiding out in the bonds. In terms of volatility, we'll wrap it up on volatility. That's really all I've got for you on today's episode. It's a shortened week out there. So, and again, I'm actually on vacation. So looking at equal lows in the VIX, sideways down here, volatility is not perked up, but it's certainly still sustaining over that 2050, floor, right? This is acted as a floor here. So it's still opening up susceptibilities in the market to rally off of this support. A more meaningful look for bulls would be consolidation and price acceptance underneath 2050. Currently not the look, but if we have a look at the VVIX, oops, I just loaded up the same thing. VVIX is showing us that, hey, Complacency effect, some big red flags should be going off in your head. Nobody is prepared for any sort of downdraft in the market based on what the VVIX is telling us. Nobody has SPY puts, nobody has VIX calls. And if everybody floods into the same place at once, remember, it can typically produce much more harsh reactions than one may have anticipated. So being skeptical based on the VVIX as of right now, again, it sort of aligns nicely with the neutral outcomes that we've been talking about. Be prepared if things do start to break down. Contango, yes, absolutely, still moving in the downward direction. A little bit of a divergence between the 9-day VIX and the 30-day VIX here versus the VIX futures, but still overall in a much more comfortable spot, less risk in the present versus in the future, which money managers do technically like. We'll see if this changes into 2023. Remember, it is a shortened holiday week. Wall Street is on vacation. I am on vacation. And we're just checking in to make sure the market hasn't done anything absurd. Doesn't look like it. Seems like it's fairly neutral out there. I would watch the 3 equal highs in the S&Ps. Maybe watch for a lower high if it does break around 390. Staying in this range is bearish. Bear flags on the table. Head and shoulders is on the table. Looking for continued bearish outcomes until proven otherwise. I don't think anything impressive will happen until 2023 comes round. With that being said, everybody, enjoy the remainder of the trading year. Enjoy the happy new year. Spend some time with friends, loved ones, family, whoever you've got around you. And I'll catch you in the new year.